hundreds of millions of dollars are pouring into this new kind of company. A kind of company that doesn't sell products the way that Apple or Tesla does. These companies will actually raise money from investors, either in the form of equity or debt, and actually take that and go out and buy crypto. And guess what they do with it? Nothing. They just sit on it. Taking into effect that cryptocurrencies are probably the fastest growing asset class, this could be a genius move. But also taking into effect that some companies are borrowing insane amounts of money to go and make these purchases, this could also be completely catastrophic. Today, we're asking the questions that everyone wants the answers to. Are crypto treasury companies a once-in-a-generation opportunity or an obvious disaster just waiting to happen? Stick with me, because by the end of this video, you'll know exactly how to spot the potential winners and the ticking time bombs. Before we can understand why some CEOs are betting their entire reputation on this little digital money thing called Bitcoin and cryptocurrency, let's first take a second to also understand what a treasury actually does. Think of a treasury as a company's internal bank. It's just money that they have from their operations that they then need to manage within the business. A treasury department inside a company has a few major responsibilities. The first being cash and liquidity management. This is making sure that the company pays its bills on time. For instance, also making payroll and any other short-term obligations within the company. Next, you have this function of investment and reserves. Companies that have all this money need to park their cash somewhere. They might keep it in banks, they might keep their money in money markets, they might buy short-term bonds, or in some cases, they might even just decide to buy Bitcoin. Another part of the treasury department in a company can be the financing and capital structure side of things. This side is all about handling debt issuance, so the company going out and raising money, for instance, from investors, managing credit lines and investor or lender relationships. And then you have the risk management piece of the picture, where, for instance, you have people looking at interest rate changes and what risks that may bring to the company. Okay, so now we have the idea of a treasury and what a treasury department in a company does. Now let's imagine that we take that treasury that is a very well-balanced system, and instead of using bonds and short-term securities as the thing that we're investing in, we just throw in a whole different kind of variable, which is the most volatile asset in the world, called Bitcoin. Well, that is exactly what these crypto treasury companies are doing. Now let's go back to where this all started and talk about the company that did this first. In the late .com boom, there was this rising star of a company ran by a man named Michael Saylor called MicroStrategy. By early 2000, shares of the stock in this company soared and then precipitously declined by 90%. For most CEOs, that would have been and was the end of the story. Fast forward 20 years and we get the 2020 phenomenon, rates at zero and companies flushed with cash. Michael Saylor, that same CEO from the 2000s, saw that the dollar was in the middle of an absolute free fall in its value. In August 2020, Michael Saylor and the company MicroStrategy, which was a software company from the 90s, took a major pivot. MicroStrategy becomes the first publicly traded company in the United States to use Bitcoin as its primary treasury reserve asset. Now, this all started simply enough, right? They took $200 million of cash that they had sitting on its balance sheet and from its operations from its software business and bought its first batch of Bitcoin. Then after that, just 1 month later, it took another $175 million and bought another batch of Bitcoin. Now, once again, just to reiterate, most companies are taking their treasuries and using those to buy bonds and other safe short-term instruments. And MicroStrategy was actually taking their treasury assets and buying Bitcoin, the most volatile asset in the world. But that wasn't even the crazy thing that happened. What was crazy was when MicroStrategy started borrowing money to go out and buy Bitcoin. The first form of debt that MicroStrategy used to go out and buy Bitcoin was a convertible senior note. A convertible note is fundamentally a corporate bond. It usually will pay a small amount of interest called a coupon and has a fixed maturity date that the company has to pay back at a certain time. Now, the twist in this and the word convertible here means that there's actually a set price at which the lender can actually convert this debt into shares of stock of the company that they're lending money to. So if the price of the stock goes up and up above that level, then the company can actually benefit from converting that bond into stock at that preset price. So in other words, investors in convertible notes or convertible bonds get the upside if the stock goes up, but then also have downside protection in the form of coupon payments and will also get paid back their money at maturity in case the stock doesn't perform as well. Now, in return for this arrangement, the lender actually gets a much lower coupon rate than they would if they were to just buy a non-convertible bond. And then what about that senior part of the senior convertible note? Senior debt holders get paid first, right? So they get paid before junior debt holders get paid, and they get paid before even preferred stock or common stock owners get paid. The order goes exactly like that. You have senior debt, junior debt, preferred stock, and common stock. Now, in this case, the assumption is that the preferred and common stocks are getting paid dividends. That's why there's a question of whether or not these two get paid. This is the arrangement where the preferred stock and common stock holders are going to get paid very similarly to how bond investors get paid as well. Now, the other side of this is also the protections that you have in a bankruptcy. For instance, if the company goes belly up, the senior debt holders are first in line to get paid, then the junior debt holders, and then in the terms of equity, you pretty much would just get wiped out. So think of senior debt as being first in line to get the cash. It's the better form of debt and also much less risky compared to equity. But in the terms of a convertible senior note, you're also still getting the upside of the company performing well and the shares going up in price. Convertible equals an option to turn a bond into stock, and senior means you're first in line for the cash. In note just means that it's a loan or a bond. So for investors, these senior convertible notes that are designed to go out and buy Bitcoin are a really interesting bet, because essentially you can benefit if the company's Bitcoin stash goes up, but you're also not necessarily on the hook because you can get paid even if that doesn't work out. Now, back to MicroStrategy. Its convertible debt notes have looked like this. In December 2020, MicroStrategy raised $650 million in these convertible notes at a 0.75% coupon maturing in 2025. In February 2021, MicroStrategy raised $1 billion in these convertible notes, this time actually at 0% interest. So essentially, MicroStrategy was raising money at near zero interest to go out and acquire Bitcoin, which is, yes, one of the most volatile assets ever, but also one of the best performing assets in the world. Now, next, MicroStrategy in mid-2021 actually started raising money in the form of at-the-money equity programs. This allows the company to actually issue new shares in the company to go out and raise money to buy Bitcoin. Now, the big downside to any equity strategy like this is that the previous investors in the company's stock are actually going to be diluted. Imagine that you own a piece of a pie and the company, MicroStrategy, goes out and raises more money in the form of equity or issues new shares, therefore increasing the overall size of that pie. But your piece stays the same. So now you own a smaller percentage of the company, even though the overall pie grew bigger. Now for MicroStrategy, this was great because once again, they've raised even more money without having to pay any interest to go out and buy Bitcoin. Now, as an investor, this can be a bit of a risk for you because more shares might make it a little bit harder for the demand to meet the supply and therefore for the price of your shares to continue to go up. Fast forward a little bit to 2024, 2025, and MicroStrategy has actually started to offer preferred stock as well. Now, preferred stock typically acts as a little bit of a hybrid security. You're usually going to get the income that you would from a bond-like instrument, but you also still have shares or stock in the company, so you can participate in the upside as well. The way that preferred shares usually work is that you have a fixed dividend that you're being paid. The fixed dividend would be senior to the common stock dividend and would get paid before then, but would also be junior to the debt holders in the overall capital stack. MicroStrategy created the perfect offering for the income-seeking investor, while once again taking that money and going out and buying Bitcoin. Now let's add all of this up. By mid-2025, MicroStrategy owns more than 200,000 Bitcoin. They've bought this using over $5 billion in its own cash, equity that it's raised, and debt from other investors as well. And so far, the market has absolutely agreed with MicroStrategy and its strategy. The stock has continued to soar over time and has done more than a 10x since they began this strategy. Now let's zoom out a little bit, because this is pretty wild when we really think about it. Buying Bitcoin with cash is one thing, but having this extremely complex capital structure with a bunch of debt involved to go out and buy Bitcoin is a whole nother thing. By the way, MicroStrategy is not the only one doing this now. We have a ton of copycats all over the place. So let's look at the valuation metrics that we can use to understand the full picture a little bit better. The first one of these is MNAV. MNAV is the market to net asset value ratio. This is a way to see if a company trades at a premium or a discount of the stash of the crypto that it owns. If the MNAV is greater than 1, then it means that the market is valuing the company more than just its crypto stash. One reason that this could happen could be that the market believes in the management team and their ability to go out and to continue profitably acquiring crypto. Now, on the other hand, if MNAV is less than 1, then it could mean that the market has way less confidence in this company and is skeptical about whether or not this company can pull off its strategy to acquire cryptocurrencies. It could be that the market is seeing that the company may have some problems paying off its debts, or that there may be some other operational risk that is involved with the organization. But now, calculating the MNAV alone can be a little bit misleading because of that debt piece of the situation that we talked about a second ago. Another valuation metric is the adjusted MNAV. Essentially, what this does is simply takes the debt into consideration. This is a little bit of a safer way to look at the health of the company's ability to go out and acquire cryptocurrencies. When you really think about the fact that these companies are raising these large amounts of debt to go out and buy crypto, it's not a surprise that many analysts out there call these companies leveraged crypto ETFs in disguise. But I think the biggest thing that we want to ask here is, why are these CEOs doubling down on all of this activity anyway? One reason is for treasury diversification. Buying crypto, and specifically Bitcoin, maybe is a hedge against inflation. The second reason is for a strategic capital advantage. When their stock price goes up, they can issue debt, and then they can take that debt to go out and buy Bitcoin. Another really big part of this that people might not want to admit is that they're doing it for hype. I hate to say it out loud, but it kind of reminds me of the other times in history where things get overheated. For instance, in the 50s and 60s during the electronics boom, where companies would add the word electronics to their name and all of a sudden double in price overnight. Or in the dot-com bubble, when you would add .com to your name and then watch the stock price soar. A lot of what's happening here, to be honest, is a lot of companies seeking press announcements and having that be the actual reason why the price of their stock goes up. Everyone wants to be the first company to use some specific asset as their treasury reserve asset and letting that be the reason that people should invest in the company. Now, besides all of the mania and the hype, is this strategy of raising money from investors to go out and buy crypto smart? Maybe. But if so, probably only for a very select few. The level of financial engineering that is necessary to pull these kinds of strategies off is not something to scoff at. What Michael Saylor has done is extremely and incredibly unique. And trying to copy him, that's probably not a very good idea. In my eyes, a lot of these are train wrecks that are waiting to happen. MicroStrategy's timing was legendary, but copycats coming into the game, juggling debt, share dilution, and an asset that trades 24/7 and can just drop 30% over the weekend, a few boards, few CEOs and very few CFOs can really pull this off over the long term. That's my personal opinion, but maybe it's just me, because I know that I wouldn't even dare to try. So are these crypto treasury companies the future for getting Bitcoin exposure? Or are most of these companies just ticking leveraged time bombs? I think you got my answer. Let me know in the comments down below. I'm Keith D, here to talk everything money and markets. See you next time.